Morning, everyone. My name is Mason Duke, and I would like to welcome you to today's class on behalf of the Economic Alliance. We're very pleased to be joined by Gwen Kohl, who's a business advisor with Business Impact Northwest, and she's here today to talk to us about access to capital. Go ahead, Gwen.
Awesome. Thank you, Mason. Thank you everyone for joining us today too. This is such an important topic for small businesses. So my name is Gwen Kohl. I have been a coach with Business Impact Northwest for about 3 years now, but I've been doing this for closer to a decade and a half. I'm a certified small business coach with International Association of Accredited Small Business Consultants. I'm also a certified credit counselor. Um, it's one of the biggest hurdles to small business funding. Even though it's a business loan, they check your personal credit. So Business Impact Northwest really works to mitigate all those factors. Business Impact Northwest is a nonprofit CDFI. That's a a community development financial institution. Been around since 1997, and we serve businesses and entrepreneurs in Washington, Oregon, Idaho, and Alaska. And so we um, when we talk about access to capital, we have a couple different programs at Business Impact Northwest in order to fulfill this mission. We do small business lending. We also do a lot of that coaching, that one-on-one technical assistance. And that's what this workshop is about, to kind of help go through what is capital, how do you access it, how is it different from, getting a loan from using working capital, right, from your revenues. So we're going to go through some definitions, common confusions with capital versus operation expenses, how to access it specifically, how to access it a couple different ways, and then we'll focus very specifically on debt funding to access capital and what to prepare for when you're seeking a loan. How all the documents that go into that, what does the process look like? And then flip on another hat for a second as a small business owner and talk about from a lender's perspective, what do lenders look for, what makes a strong loan application, and some tips and tricks to help strengthen that before you go and apply, to help increase your odds of getting approved. So when we talk capital specifically, it's such a broad term and it can be used to describe really anything that generates value or benefit to its owners. For businesses, that can be a factory, it can be machinery, intellectual property like patents, or it can be the financial assets of the business or individual. And so as a financial asset, capital should be seen as a driver to produce value, because assets are used to produce goods and services, fund operations, and drive business growth. Basically, assets are used to produce the sales revenue needed for working capital and for profit. They can be in any form: cash, savings, equipment, personnel, staffing, property. Assets are necessary to produce profits. So this is a lot of what shows up on a balance sheet in a financial statement for a small business. But it does cross over into the profit and loss, because money itself can be construed as capital. It's more often associated with lump sums of cash that is being put to work for productive or investment purposes. So it's a critical component of running the business from day to day and also financing future growth. And small business lenders really look at that growth aspect. They are hesitant to fund businesses just trying to cover operational day-to-day operational expenses, right? You need to be able to leverage capital into more revenue. And so when we talk about capital from a business standpoint, it can derive from operations of the business, or be raised from debt or equity financing. And when budgeting, most businesses typically focus on three types of capital: working capital, this is the day-to-day operations; equity capital through owner investment or outside investment; and the debt capital, that financing or funding part, or loan part. There's also a fourth one. Businesses in the financial industry identify trading capital as a different type of capital, but unless you're in the finance industry, don't worry about this. I just want to make sure it's on your radar if you hear somebody reference it. But for most small businesses, for all small businesses outside of financials, it won't impact you. So when accessing capital, the three main things to consider uh, for the need for funding are business stage, need, purpose, use of funds, and what resources you have. So small business owners don't always know where to look. So sometimes if you're finding funding difficult, you're maybe looking in the wrong place or not taking these three things into consideration. Or you might not be ready for that type of funding that you're looking for. It's kind of like a pair of shoes. You need the right type for the right purpose. So you want to consider these three things to start and help you figure out where the right kind of funding to look for your business. So the first thing is business stage. It does matter how long you've been in business regarding what funding you might qualify for. In the lending world, businesses that are less than 2 years old are still considered startups. This is 2 years of tax returns filed, completed, on record. If you don't have 2 years of tax returns, then you're going to be funneled into that startup realm, and the criteria could be different, or a lender might not lend to startups at all. There's just not enough financial history for lenders to make decisions if they don't lend to startups. And if they do lend to startups, we'll talk about what that different criteria is that you'll need to prepare for. And then for the need for funding, purpose of, and use of funding, you really need to have this clear. So what is the need for capital? What is the purpose driving this need? If you have more customer demand than you can meet, then the purpose could be to increase capacity to produce or to deliver more goods or services. Or you could be expanding into a second or third location or a larger location. So exactly how will capital funds be used to fulfill the purpose in your business? And the more specific you can be, the better. And we'll get back into this in a second with some examples too. So once you have your business stage and the need, purpose, and use of funds, look at the resources you have available. So is there anything inside your business that you can use, or do you have to look outside of your business? And if you can use internal resources, it'll cost you less in the long run, because as soon as you look outside of your business, there's always a cost to it. So if you do need to source capital outside, what's the best external resource for you to look for funding? Are you looking for investors, or are you going for debt financing? And the more research you do into this, the more you will set yourself up for success, because it's just as important as, are you the right entity type? Do you have a strong marketing plan? Do you have a great product or service? If you're finding the capital source that's the right fit for your business, the better off you'll be in the long run. So how do you actually access capital? Where do you look? There are different sources of capital depending on different resources that you have available. The business stage does play a large role in where you can access capital. Startups just don't have existing revenue to pull operating capital from or working capital from. And so if you're a startup, often initially funded from owners themselves, owner investments. Some startups, especially if they plan to scale quickly and have an exit strategy, like Tech World sees this a lot, you're acquired by a larger company. Those types of startups are a good fit for outside investors, because that investors will make money quickly, right? But if that's not your plan, that's not your industry, it's not what you want to do, then you're probably not a good fit for investors. And so you're left with either self-funding or looking at debt if you don't have revenues to pull from. And this is where existing businesses also look first as well, to that debt funding, because not everybody wants to trade equity, ownership, stake in the business for funding. But debt can be intimidating, and there is a cost to it. But if you learn how to manage it strategically, you can help your business start or grow, and it can be a great resource, especially for larger projects, more expensive equipment, things like that. So for the rest of the presentation, we're going to focus on debt funding, like through banks, credit unions, CDFIs, community lenders like Business Impact Northwest.
Morning.
All right. So looking at debt funding specifically, this is so important. Whoops, too far. So important to have the need, purpose, and use of funds extremely clear before you go and approach a lender or formally approach a lender. Thoroughly understand and be able to explain how much money you need, what that dollar amount is, and why you need it. I have so many small businesses come to me and say, well, how much can you give me? And that immediately puts up a flag for the lender to say, well, have you done your research? Like, are you buying equipment? There's going to be a pretty solid cost to the equipment. There might be a range if you buy it used, but that you should have that number in your head. And then, so for that use of funds too, it's going to determine where you're looking. So if you're looking for a loan to purchase new equipment, that's a pretty straightforward loan. But why do you need that new equipment, right? Is it a nice to have or a need to have? So if you're turning away customer orders due to limited fulfillment capacity, that's probably a need to have. That's you need it in order to scale your business to increase revenues. And that money, that ask that you make could include the equipment. It could also include, covering payroll for hiring maybe 2 more employees to train on the equipment before it's actually in production. And there could be marketing in that loan ask too. So you can use a loan for multiple things, but you need to have it clearly thought through. First example we'll go through. Your ask is 85,000 for increasing capacity in your business. The use of funds is 55,000 towards equipment purchase, a large piece of equipment. 25,000 to hire and train 2 new staff over 90 days, and then 5,000 for marketing and advertising to increase your revenues as well. Something to note here for that 90-day staff, payroll covering for staff, lenders generally don't like to cover more than 90 days, right? They'll do 3 months of that operating expenses, but beyond 3 months, you really need to have your revenues grown enough to cover your general operating expenses. There are some exceptions to that if you're in an industry that has a big R&D, research and development division that you need to spend more time to develop the product. But in general, small business loans aren't going to necessarily be doing R&D, so they're not going to be looking to have a use of funds beyond 90 days. So keep that in mind. Second example, let's say it's a $150,000 loan. The purpose is business expansion into a new location. So use of funds will be 110,000 in tenant improvements, 30,000 to cover payroll for 3 months during the build out because shop's going to be closed, and then 5,000 in signage and 5,000 in a marketing budget. Something that's super important in this example for tenant improvements, there's a build out. If this is your loan ask, then when you have that use of funds clarity for the loan application, you should have a signed letter of intent with a property owner. Doesn't have to be a signed lease. It just has to be a signed letter of intent that says, this is the property I'm moving into. Here's all the work that needs to be done in order to make it a good fit for my business. And here are the quotes or the bids that I've gotten on that construction, right? So you need to be in those negotiations. The reason is because if you switch locations, all that cost is going to change, right? A different location is going to have a different lease, different lease terms, different build out needs. And so it's kind of like, which comes first, the chicken or the egg? They both need to happen kind of concurrently, right? So you're in negotiations with the property owner, and you're also getting those bids for the build out and seeking funding, debt funding for a loan to cover the cost, all at the same time, right? So it can be super stressful. There is definitely a timeline associated with it, but just keep that communication moving forward. And then don't sign anything, don't commit to anything until you have the funding secured. But you need the specifics in order to secure the funding. So it's a process, right? The use of funds details should support the amount of capital you ask for through the specific examples and research. So that's if you're saying you're buying a $55,000 piece of equipment, you need to have recently dated dealer invoices or screenshots of where you're buying that equipment that you plan to purchase as a part of your loan application. And it's not going to be the first thing that you submit, right? But it will definitely be asked for by the loan officer at some point. So be prepared for it. Um, and then if you have a part of that working capital, like both of these examples includes payroll, you should be able to provide details like the job titles, wages, and hours worked each month. You still have that all thought out, even if they're new hires, they're new employees, right? You need to have plans to hire them and all the details that go into that. So once you have this sorted internally for your business, um, what's next? Where do you go? You start looking at the loan types that are going to fit the best with your purpose of the use of funds. And there are different loans and different lenders don't do all of these. So it is research, right? Most common ones, small business loans, commercial loans, SBA loans. There's a lot of overlap here. SBA is they're government backed, so the SBA is not a lender in and of itself. They partner with banks and credit unions and CDFIs to help secure the collateral aspect, the back end of the loan, to make it less risky for that lender. But lenders, even if they do SBA loans, they usually have their own in-house small business loans as well. And commercial loans tend to be larger. So if you're a small business, looking for $50,000, if you're looking at a bank that does more commercial loans that are like in the millions of dollars range, they might not do a $50,000 loan. Even if you meet all their qualifications, it's just too small for them. So look at other places, right? Merchant cash advance is a specific type of funding for established businesses through however you process customer payments already. So QuickBooks does their own loans. Those are merchant cash advances. Some other credit card processors, Stripe and Square. Be very careful if you go this route. It is easier to get this type of money for established businesses because the merchant sees exactly how much revenue you process every day. Sometimes they offer you money. Like you might not be seeking it at all, but you get an email from them. Hey, like we'll give you $30,000. But there's a cost to it. So make sure you read the fine print, know what that cost is, and then have a path out because these merchant cash advances are really easy to get caught in because their repayment method tends to be a percentage of your daily sales. So that cuts into your cash flow. And even though you may pay it off quickly, it's easy to get like the next one, right? Because they'll push it on you. And so you want to make sure that you are using it strategically and leveraging to a place that you want to be in. You're not relying on those merchant cash advances because they are expensive. Then there's real estate financing. So some places only do real estate financing. They specifically focus on that. So if you're not doing real estate financing, don't go to that lender. If you are doing real estate, you're looking for real estate funding, you might want to go to a lender that specifically does that because it will be a more streamlined process. Same with equipment financing. If the only thing you're purchasing in the business is that equipment, you're not doing working capital for payroll, you're not doing signage, anything else. It's just that piece of equipment. Oftentimes you can get equipment financing through a bank or even through the vendor that's selling it, right? That store that's selling it. And so that might be perfectly fine for your business and just go through the terms, right? Know what the interest rate is, know how long you have to repay it and what that means your monthly payment is. And then the last two here, franchise loans and disaster loans are very specific. If you're opening a franchise, sometimes the franchise wants you to work with a particular lender, or if they don't have a particular lender in mind, you might look for somebody who does a lot of franchise lending because it's a whole different world to purchase a franchise. And so the paperwork is different, the criteria is different, and so you want a lender who's familiar with that process. And disaster loans are available for areas that have been declared disasters. Um, and they're small business loans. Their disaster loans are also available for individuals as well. If you own property that is damaged in a declared disaster zone, or if you rent. So keep that in mind too. If you're just a individual who rents an apartment or a home and you're in a disaster zone, something happens, the flooding, fire, something like that, there is a process for you to get funding. It's usually not too expensive too, so it's not free. It's never free, but it is a really good resource to help rebuild. And then all of this too, keep this in mind, if you are under 2 years old, you are still in the startup world. And so there will be different criteria as a startup, and some lenders, even though they do small business loans, if you don't have those 2 years of tax returns, they won't do a startup loan. So you'll look for a different lender. You can still establish a relationship, open a business bank account and say, hey, like I'm doing this, you're moving forward, and they'll see, how track the account balance. If you often would overdraw that account, then in the future, if you ever need a loan, it's going to damage that ability to get that loan. But if you can keep you know, a good track record in your account, you're starting to establish that relationship with that bank or credit union or lender to have the possibilities and the opportunities in the future. And then it's never too early to prepare. So think ahead, plan ahead. The worst time to apply for a loan is when you are already in that cash flow crisis. It does happen. It happens very often, but it adds a lot of unnecessary pressure to something that's already a complicated process. So if you can set yourself up in advance for before you're actively seeking funding, it will help that process be smoother, less stressful, and faster. So what you do now helps to set you up for better options, better opportunities. Know your capital needs, know your financial projections. So this is something that a lot of businesses skip. But if you plan ahead for what your revenue and expenses are likely to be, you can start to identify any gaps that you have. And then you can start finding resources to fill those gaps. So if it needs to come internally, if you need to save a little bit of your revenue, if you have a busy season and you can save that to get you through a slow season, or if you need an owner investment, or if you're going to look for a loan or a line of credit that you can draw down from in order to fill that gap, and then apply for it when you have the cash flow before you are in that crisis where you have that funding gap. And then how you go about, so once you have this planning and you're thinking ahead and thinking through all the things, the how you go about actually putting the loan application together is going to depend on these 5 C's. So lenders often look at the 5 C's of credit to determine how risky it is to lend to you as the borrower, as the business or the business owner. So if you're thinking about starting a business too, it's good to take these into consideration. They look at character, and this is primarily determined through your credit score. So it's your credit behavior based on indicators like the credit report score and payment history. Most lenders don't have a bottom line anymore, but they will, if your score is too low, the factors that go into that score are likely going to be prohibitive of getting approved for a loan. Because the two main factors that determine your credit score are on-time payments and the rate of credit utilization. Both of those, so on time payments, if you have a track record of failing to repay debt, that's a big flag for a lender. And then the amount of credit utilization, if you are maxed out on your existing revolving debt, like credit cards, things like that, um, lenders look at your debt to income ratio. And so if your debt load is too high, that's also going to prohibit a new loan. So those two factors in your credit score are very important think through and maintain favorable history to improve your likelihood of new debt in the future. The next thing they look at is capacity. This is your financial ability to pay the lender back. So this is cash flow on hand, the revenues in the business, the track record, so the historical financial statements and tax returns. This also comes into factor with your debt to income ratio. So do you actually have the available money to repay the loan? And then they look at capital, so the money you are already putting into your business. It's often called a down payment. Not every lender requires it to be what we think of as a traditional down payment. Like if you go to buy a car and you put money down, you actually have that cash on hand to put towards the car. A down payment in a small business loan can be money that you've already spent in the business. Like you as the owner have, provided startup funds or the business itself from its revenues, operating capital. It pays the insurance bill. It's already paying the lease and the utilities if you have a physical space. And so you're putting your own capital, your own assets into the business, and that can be considered for the down payment, for the total ask request of loan funds. So it's a little different to think about it that way, but either way, you need to be putting your own money, your own assets on the line for this business. Because that means that you're more committed to it. It's very easy to risk somebody else's money. It's harder to risk your own money. So lenders want to see that you are invested in the business. And then small business loans almost always require collateral. This is an asset that you pledge to back the loan. So it can be equipment, vehicles. Real estate is the favorite collateral because it appreciates, and so it grows in value. So the likelihood, worst case happens, and you can't repay the loan, and the collateral gets turned over. With real estate, they're very likely to recover the amount of the amount you still owe off that original debt. But if you don't have real estate or it's already leveraged elsewhere, then vehicles are a good option. The newer vehicles and equipment are going to be worth more for collateral than older ones, but they're still worth something. Some lenders accept inventory as collateral, some don't. It depends on the lender. And if you think about it from, put that lender hat on, pretend for a second that you're the one lending money out. If somebody turns over, a bunch of books because they have a bookstore, do you know what to do with them? Do you have the infrastructure set up to resell those books to recoup the money that you lent out originally? It's harder. It's for a lender, almost never do they have the industry experience to resell your inventory. So it's worth less as collateral, even though it's worth a lot to you because you have the infrastructure and the network set up to sell that. So the bigger things are better, such as equipment, vehicles, and real estate, far preferred for collateral. And then the fifth C that lenders look at are the conditions. So this is a market analysis of the trends in your industry. And this is outside of your control. It's kind of like what is happening. And lenders, if an industry is too risky to lend in, sometimes lenders will say, we're not lending in this industry. And so even if you have a perfectly solid business plan, if they don't lend in that industry, it's not the right lender for you to go to. If they do lend in the industry, but the conditions are risky, outside factors are affecting it, If you have a plan to mitigate that, if you have resources or you have a plan to pivot, maybe the funding that you're looking for is to make that pivot. That can still be accepted. But you have to share that knowledge to portray like, hey, this is the plan, right? We are very aware of the conditions in our markets, and this is what we're doing about the risk factors. So that goes into your business plan and other loan documentation.
On the last slide, you mentioned equipment financing. I was wondering if you could just speak a bit more about that and what it looks like, how it's different from the other varieties of loans.
Yeah, so equipment financing is a amount of money specifically used for a piece of equipment. The examples I shared included equipment and payroll and signage or marketing money. And so if you don't need those extra dollar amounts to cover staff training before you can leverage it into revenues or whatever that looks like, then go for a loan specific for equipment financing. And the only thing it would cover is that piece of equipment, right? And this is so wherever you purchase the equipment, um, like you go down to the tractor store and you want a tractor, they often have the ability to finance that equipment. So you don't even need to go to a bank or a credit union. You can just do equipment financing through that vendor. And that vendor won't do like a traditional small business loan. They won't cover any of your payroll. They won't cover working capital. The only thing they're covering is that equipment. Um, and this is a pretty straightforward process, like a car loan. And so if you want to, go to a bank or a credit union because the interest rate on that equipment financing will be more favorable, then sometimes you can go there first and then go down to the store and say, hey, I need the tractor, I need the heavy equipment. I have financing already for it from this bank or from this credit union. Um, and and go through the process that way. It's often also a faster process because you don't need it's very straightforward, right? You're purchasing the equipment, here's the cost of it, here's everything that goes into it. Whereas if you're looking for a working capital small business loan that has, five different uses of funds, you have to provide the paperwork for all those uses of funds. And also from a collateral standpoint too. So if you're looking at that collateral piece here, an equipment loan typically just uses that piece of equipment as the collateral. It's what is pledged against it. Same with a car, right? The car, if you fail to repay the car loan, then they're coming and they're taking your car. So it's from a collateral standpoint, it's much more straightforward as well. You don't have to go through, other vehicles, other equipment, place real estate on the line, anything like that. It's just the piece of equipment you're purchasing, financing for that, and you have the repayment plan, and the equipment itself is the collateral. Yeah, awesome. So next we're going to start looking at risk factors. So if you're thinking from a lender perspective, your ability to repay the loan is the lender's main concern. So the lower your risk is in as the lender sees it, the more likely you are to get approved. And you can get better terms, so better interest rates, um, a more favorable repayment plan. So instead of maybe 3 years to repay it, they'll give you 5 years to repay it, and that reduces your monthly payment, which increases your cash flow. And something to take into consideration there too, some lenders do have a prepayment penalty, which means if you pay it off early, there's a fee associated with it. I would say don't ever take a loan that has that prepayment penalty. There are plenty of lenders out there that don't have a prepayment penalty. And so if you can get a 5-year term with a lower monthly repayment, then but you can pay it off early, do it, right? There's nothing to stop you from paying it off early, but it's a safety net. So if you have a slower season and the minimum payment, is $250 a month and that's all you can make in your slower season, that's fine. But then you have a couple busy months, maybe you double it and you pay back 500 for a couple months during your busy season to reduce that and pay it off early. That's awesome. That's good cash flow management. But if they lock you into like, no, you have 3 years to repay it or 18 months to repay it, and that jumps your monthly repayment up to like $600, then you always have to make that minimum payment. Or it, starts to show up on your credit score and you fail to maintain a solid relationship with that lender. Um, and if you communicate that too, especially with community lenders, if you are proactive about communication, we do a lot to help you through those slow periods, right? We can do interest-only payments for a certain amount of time. We can try and lower your payment. But you have to be proactive about that communication. So you have to reach out and say, hey, there's a cash flow crunch coming up right now. These things happened. Can we work something out? And you always have to pay back the full amount, but if you need a couple months of a lower payment, then usually it's no problem. But then you have a couple months of higher payment, or they'll wrap it all into the end. So your final payment will be making up the difference. So, but it's way better if you are proactive about that communication than having a lender reach out and say, hey, your payment bounced, what's going on? It's maintaining a better relationship with the lender, it's gonna keep opportunities open for you in the future. It's that track record, right? Even because small business, right? We know things happen, but if you have a good communication track record, then even if, we lower your payments for a couple months, but it's a good relationship, then usually it's fine if you need a second loan later. As long as you did end up paying it back, right? If you defaulted on it, there's much more risk that the underwriters will look at and say, yeah, we don't know if this is possible, based on the history, right? Um, but it's also everything is changeable. So if you can repair a relationship, then again, be proactive about it. Um, and this is all, so these risk factors, that's what they're looking at from those 5 C's. Your history, have you paid back other loans? Do you have a track record or revenues, or good solid projections and estimates that you will have revenues in the future? And a plan to pay back the loan. So how is the funding, how will that allow you to scale or grow your revenues, to be able to pay back the loan and then increase your revenue and your profit, especially from a community lender like Business Impact Northwest. A part of our mission is to help businesses create thriving communities, right? So we want small businesses to succeed. We want you to be out there doing awesome things in your community and making a profit and supporting jobs or contributing back, whatever that looks like. So we go above and beyond a lot of bigger traditional banks, when we do the loans, but you still have to meet the criteria. Um, so what goes into the loan application to meet that criteria? The first thing a lender looks at is your business financials. So this is the demonstration of enough revenue to support your operations, all your operational expenses, to pay down debts on top of those operational expenses, and to build business equity. So, for established businesses, your historical financials show that track record of revenue, expenses, and ability to repay debt. For startup businesses, this will be your financial projections. So what do you expect your revenues and expenses to be, and why do you expect them to be that? So it's really important if you're building out those projections, if it's required for your loan application, you need to show the assumptions behind those numbers. And then a loan officer will look if this is reasonable, right? If if you actually have the capacity to make the sales that you say you're going to make, can you deliver on these assumptions? Um, and I've had startups say, in a service industry, say that they're going to meet X number of clients in a month, and I crunch the numbers and I'm like, That means you're working 30 hours a day. That is physically not even possible. There's only 24 hours in a day, and when are you going to sleep, right? So you have to make sure those numbers actually make sense and they're reasonable, right? And if the only way you meet that capacity is if you have staff, like you have one or two additional people doing the service or delivering the product in addition to yourself, then that has to be a part of your plan and demonstrated behind that, right? So you'll have contractor expenses or payroll expenses, and it's the hiring process and the managerial experience is a part of that because not only are you delivering your product or service, you are now responsible for a team. And so that experience is important. To demonstrate that experience is important. And then sometimes established businesses may also be asked to submit cash flow projections, especially if they're opening a new location or changing their business model significantly. An example of this, we have quite a bit, is a brick and mortar restaurant opening a mobile food truck. Or vice versa, right? There's a food truck moving into a brick and mortar restaurant. And you might have an awesome track record from where you've been. But when you switch, it's going to be different, right? Whichever way you switch. And so a lender might say, we want to see the business plan and we want to see the projections, all the research that goes into that switch and why it's going to be successful. And they'll ask for the projections, right? The next thing they'll ask for is that business plan. So startups always have to have this business plan, even if they're startups and if you're switching business models significantly. The business plan shows that demonstration of that ability to generate revenue. So it should support all those financial projections you just did. It does not have to be long, but it does have to be thorough. And for startup businesses who are looking for a loan, that business plan is absolutely crucial because it's where you provide details and prove to the lender all of the reasons that you're going to be successful in your business. So you need to demonstrate your internal capabilities, the quality of your products or service, management capability, plan to generate sales, and the assumptions behind your financial projections, both the revenue and the expenses. And just generally show that you thoroughly understand your industry and any external conditions that affect your industry, including the demand for your product or service and how you mitigate any risks. And for startup businesses building this plan, if remember, startup is under 2 years old, so you might have a great track record that you can provide financial statements. You can show we have X number of followers on social media or so many contracts with other businesses or established organizations. We have a waiting list, right? We've been talking about this in the community and what we're doing, and we have an email list of people that support us. And so any traction that a startup can generate like that to show demand for the product or service is extremely important in the business plan. If it's never left your head, that's going to be a problem for a lender, because there's no way to judge the ability, the success of this. So get it out of your head, start talking to people, start building the community around it, and put together that business plan with the projections. For established businesses, the business plan is less important for a lender because the historical financial statements and tax returns demonstrate a lot of the items on this list. So for established businesses, basically double check where you want to apply for a loan if they do need a business plan from an established business. And if they don't worry about it. Sometimes they will ask for a loan proposal document instead. And this is basically just a page or two that gives a brief introduction about the business, contact info of the business, ownership structure, and the details for the loan requested, the loan amount requested, the need, purpose, and use of funds, and then how the debt will be repaid. And there are templates you can look online for like a loan proposal document, or if a lender is asking for this document, ask if they have a template or an example. And it's basically who, what, why, right? Like who are we? What are we doing? Why are we asking for money? And here's the details of that. And that, you know, easier for an established business, far easier to put that together than the full business plan if they don't have it or if they haven't updated it, right? Maybe you created a business plan when you first started, but that was 10 years ago. It's not going to be accurate. So that loan proposal document is a way to be like, this is, you know, very, very concise. This is who we are, what we're doing, and why we're asking for money. And then when you go to submit that loan application, these are the documents that are generally needed. Different lenders might have variations of this, but this is the basics of it. So that business plan, loan proposal, financial statements, tax returns, and a note of financial statements, financial projections. Usually lenders want to see 12 months of detail. So the most immediate 12 months of detail. So now it would be, we're in June, so they'd want to see July 2026 to June 2027, right? And then sometimes they ask for years 2 and 3 annual estimations beyond that, but they need that 12 months of detail for sure. And then proof of collateral, and then the capital, the down payment or equivalent that you spent in the business. Those proof of collateral often comes after the lender has had a conversation with you, looked at your financial statements, looked at your business plan, and said, yes, this is a possibility that we can do this. Here's all the further information we need. Or they might look at your financial statements and tax returns and business plan and say, this isn't an industry we fund, or we have some concerns, like here's some further stuff that we need. And then if they think that it is a possibility, they'll say, okay, what is the collateral available? And so you'll need to have that proof of collateral. Resumes of anyone owning 20% or more of the business. Doesn't necessarily need to be a separate document, but for startups, those resumes are important in the business plan, and it doesn't have to be the full resume. It just has to show that the owners of the business, anyone who owns 20% or more of the business, has the experience or the skills to make the business successful. So, a couple paragraphs or a section for each business owner that says who they are, what they bring to the table in this business, and how they contribute to the success of the business, or how they will contribute. And anyone who owns 20% or more is going to be on all the documents, and they will have their credit score checked. So it is everything that is on the criteria list. Each owner who is 20% or more owner of the business needs to make sure they meet that criteria. They'll look at business tax returns and personal tax returns. And they look at your personal tax returns, same as they look at the personal credit score. You as an individual are personally guaranteeing the loan, even though it's a business loan. Until businesses get giant and huge and like double, triple digits of millions and have boards and are beyond the person behind them, that is going to be true. You're going to be personally guaranteeing it, and so they're going to look at personal information. Mortgage statements, if you're putting real estate as collateral, then they will need those mortgage statements. And they'll want personal financial statement is required. Definitely for SBA loans, this is a document. Sometimes lenders will have different criteria for what goes into the personal financial statement, but it's a template you can Google and just be prepared for it. I think on our website, on the Business Impact Northwest website, we actually have a video that goes through a personal financial statement and what it is and all the details that go into it. So be prepared for all this documentation. And then what does the process look like? So you prepare all those documents, you set yourself up for success, you have a clear loan ask amount and use of funds. You go through the loan application with the lender. Usually it's not just on the website. Sometimes you can go in and fill it out in person, but I think a lot of lenders are making it easier, accessible online now. You go through the application, you attach any documents they require up front. Save anything that you've prepared that they don't ask for up front. but will probably be asked for in a future conversation with a loan officer. Usually get a phone call with a loan officer or set an appointment to go in person and talk through the loan application. That discussion, the lender will ask what the client needs. They help determine loan solutions if it's a good fit, if they have a loan product or opportunity that fits your needs, right? And you meet the criteria for. If that's a yes, they have all the documentation. The loan officer sends the loan application to the originator, which may or may not be the same bank. Sometimes there's a partner that goes to that they have to approve the documentation as well. And underwriters, all those parties have to crunch the numbers and approve it. It goes back to the loan officer or the credit manager. If approval is determined or not, they'll usually say why, and they go back to the loan officer. Loan officer goes back to the business owner and says, here's the deal. Documents go into processing. They start to collect signatures. They go back and forth for signatures, clients and loan officers. Final review for completion of all the documents. So every document that has been asked for is uploaded as a part of the application. All signatures are where they need to be and are complete. And then once that has been signed off on as complete, loan funds are dispersed to the client's business account or to where they need to go. So for working capital loans, and sometimes they split these, right? So for working capital loans, that loan portion can go into the business account, the business bank account. But for equipment financing, sometimes it just goes straight to the vendor, right? The capital never actually hits the business bank account. It's just a pass through. But it depends on the type of loan where that goes. And the use of funds, right? So if you have a small business loan that has multiple uses, like those examples I went through, there's equipment, there's payroll, there's signage. A portion of the loan could go into the business bank account for that signage, for that marketing, but the portion for the equipment gets split out and goes straight to wherever you're purchasing the equipment from. And so this whole process takes time. It goes faster if all the documents are complete, and when a loan officer asks for them, you're able to supply them pretty quickly. But different lenders still have different speeds that they move at, right? So some lenders are pretty quick. Small business loans tend to take 4 to 6 weeks on average. Equipment loans, specific equipment loans, can be faster than that. I've also seen small business loans take longer than that, especially larger amounts. Real estate loans also take longer than that. That closing process can take months. So have that timeline, your timeline in your business and when you need funds by, and start the application process with that a timeline appropriately, right? To think, plan for 6 weeks. If it goes a little bit faster, awesome. If it goes a little bit slower, you're prepared for it. And then that is also your decision making, right? So your projections, your plan, everything that you're looking at where you have cash flow gaps comes back to if you're applying before you hit that cash flow crunch, that crisis mode, it's easier to get that approval, right? To sit back and say, okay, this is taking 8 weeks, not 6 weeks. I'm still okay. It's fine. I can still pay, the lease on the space. I can still pay payroll this month. Like it'll be okay. But if you are in that cash flow crunch and you need it to move faster, a loan officer is only going to move as fast as they move. It's really hard to get somebody to move faster when they have their processes, their internal processes in place. And they might be waiting, right? SBA loans take a little bit longer to do because they have to go, for over certain amounts, they have to go to the SBA office for their approval. And so it's a lot of times pushing documents back and forth. They sit on somebody's desk, they sit in that queue, they get to it, they go back to somebody else's desk for that approval or that review, and they sit in the queue. And so It's just it plan for that timeline, right? Um, this is just a quick recap what lenders are looking for. So in your financials, um, equity, how much cash you have on hand or tied up in accounts receivable, what your profitability is, what your debt burden is, collateral value, your history of repayment. And then in the business plan, for established businesses, the piece of the business plan list here, it shows up in your financials, right? If it's a viable business model, you have a track record of profit. If it's struggling to be a viable business model, then you might not be profitable. You might not have that track record for as many years as you want, and so they'll look back and forth on that. For startup businesses, for new businesses under 2 years old, in that business plan, it needs to make sense, be well researched, showing your experience, and that there is that growth potential, right? Um, you don't have to make, you know, millions, right? But is the business sustainable? Are you making enough to cover expenses to stay in business and to pay the owners enough so that, the owners aren't going back and looking for a day job, right? So is the business, whatever the business model is, does it make enough to continue to be a part of the community? And then how to prepare. So, summary of that, have your books in order. If you work with an accountant or a bookkeeper, tell them that you are thinking about applying for a loan because they can help you get everything in order. Be able to talk about your financial statements and your financial position. So if you need a conversation with your bookkeeper or an accountant to make sure you're on top of that, then have that conversation. Have your strategy and your goals outlined. Know exactly what you are asking for, how much you're asking for, and how you'll use it. Do your research to see what you can provide internally, and if you need outside funding, and then put together all of the documents. And then that research part of that. So make sure you're approaching the right lender for the right type of loan that you're looking for. Um, if you need to work on your credit score, if that's one of your risk factors, then start preparing for that. It's never too early. We can destroy credit scores in an instant overnight. You miss one payment, you forget it, and it takes months to start improving it. So um, don't don't wait too long to address that if you know it's something that needs to be addressed. And you can get your credit reports from annualcreditreport.com. So the credit report is all of the information and data that goes into your credit score. And this is often a good place to detect fraud. So if somebody has stolen your identity or is opening accounts in your name, this is an early warning sign to get those details. And there's all sorts of credit monitoring places you can go to get alerts set up if you're worried about it. Um, so it's a resource, it's free. So it's your data, you have access to it. Typically, it's been once a year you can get it. And I think the past year-ish, they've been letting people pull their credit reports every week for free. So definitely something to be aware of. And then how and when to apply is that timeline. If you completed the preparation and the research, choose the right lender, ask questions. You can always reach out ahead of time and be like, hey, I want to make sure I'm setting up for success for the loan application. What should I be aware of? And they should be able to give you a list of criteria, the documents you need, what they look for. Submit it and then just be responsive and have open communications with your lender. That will help you. And then as I wrap up here, Business Impact Northwest has awesome resources. So we do coaching. Our coaching is free, one-to-one coaching. We do business strategy and advising. We also do loan readiness. So if you are looking for a loan and you want help preparing documents or thinking through all the things that I've covered, we can help with that regardless of where you get a loan, right? It doesn't have to be a loan through us. It can be a loan through your local credit union, your local bank. We're still here to help business owners get set up for success. But we do have that lending arm, and so it is an option, especially if you go to your bank or credit union first and get turned down. Um, that access to capital part of our mission, we really want to be helping businesses access capital. So if you've gotten turned down from a bank or credit union, come chat with us and we'll see if it's a possibility or give you a list of things to work on before you come back and apply. We also do coaching. I say coaching. We also do workshops, events, trainings. We have a lot of on-demand stuff as well as live stuff, virtual or in person. So you can check that out on the Business Impact website, which is businessimpactnw.org. And then lending specifically, what we have, we are an SBA lender, so we do microloans, so 50,000 and below. As small as 5,000. We can't go below 5,000, but for 5,000 to 50,000, we can do those microloans. We do other term loans up to 750,000 and real estate up to 1.5 million. We work with established businesses and startups. So we are one of the few that will do startup lending. We do work with established nonprofits for loans. We can't work with new nonprofits, but if there's a significant track record and the mission is aligned, then we also lend to nonprofits. We do want a 1-to-1 ratio for collateral. So if you're asking for $100,000, do you have $100,000 to pledge as collateral? But that SBA lending that we do, and sometimes we've done Community Advantage SBA loans up to 350,000 too. So if we're doing that, then that's a good, and if you have a collateral shortfall, that is a good option for you. And use of funds is very broad. So equipment, payroll, working capital, inventory. We do debt refinancing. Another note on debt refinancing. So if you have merchant cash advances that you want to get out of, those are difficult to refinance, and the SBA has actually said they won't refinance them. So it's a big flag word of caution if you go for merchant cash advances and you get stuck in a loop with them. They are difficult to refinance. If you have other term loans or like you get a piece of equipment through the store itself and it's a high interest rate and a couple years down the road you want to refinance that is easier to refinance. It's a pretty straightforward deal. But how the merchant cash advances set up their repayment, it's more difficult. So keep that in mind. And that I think is the end of my presentation. So thank you. Any questions too? We do have time for questions about anything that I've covered.
Regarding the business plan, Gwen, I know that traditionally those can be very long documents, like 30, 40 pages. Has there been a tendency over time for those to grow shorter, or does it all kind of depend upon the nature of the business and its complexity level?
Um, Nature of the business and what you're using the business plan for. So if you're looking for investors, angel investors, or venture capital, those still have very long business plans, like hundreds of pages, extremely detailed. For a loan for debt financing business plan purposes, we like shorter documents. As long as it's thorough and it answers like all the questions that a lender will have about your business, I mean, it can be 2 pages. Like, that's fine. I've seen people try and get 1 page business plans done, and that's a little short for a startup business. But it's a good place to start and just use that as your executive summary. So it gives the overarching information and then attach, a couple pages beyond that 1 page business plan that has more of the detail. Because for a startup, you do need to really show the assumptions behind your financial projections, and the experience of the owners and why you are the people to make this business successful. And that it just takes a couple pages, but yeah, don't make it super long. Like we don't need 30-page documents. A handful of pages is awesome. So.
I just had a quick question, and I know you probably touched on this, but one of the challenges that we see most is with our startup. Um, folks who might not have, the 2 to 3 year lending history and, that really only need that five to $10,000 to get started. What are your strategies and how have you helped some of the small businesses get the funding that they are looking for to help them get started?
Yeah, that's a great question. It is really challenging for startup businesses. One of the things I do in coaching startups is try and plan um, a plan of attack essentially for how to get started and maybe build slower. So they have at least some track record. Maybe they're doing markets, pop-up markets or something. And so they're not going from zero revenue in their application, even as a startup. They're showing they have some revenue, and that there is a demand for that for their product or service. And that can help a loan officer and underwriters say that this is, it's a business. It's already in operation. It's not just an idea. And so that helps increase the likelihood to secure funding. Is still, still have to meet all the other criteria. It is easier for those smaller loans, 5,000 to 50,000, any micro loan. It is easier to get approval without a one-to-one ratio of collateral. So if you're asking for 45,000 for something, but you don't own any real estate, you don't own your home, you have, an old vehicle that you've paid off that isn't worth much, but it's something. Underwriters are much more likely to be okay with that collateral shortfall in a micro loan than they are in a larger loan. And then don't ask for more than you need, right? So if all you're looking for is $5,000, ask for $5,000. Have the use of funds lined out for how you'll use it and what you're purchasing and how you'll leverage that purchase in order to make more sales. It might be signage on a building. Maybe you're in a historical building or something that has the property owner says the signage has to meet this criteria, right? And it's external signage is expensive. And so like look for a loan that covers what you need but isn't more than what you need because there is cost with expenses with interest expenses and fees. And then yeah, just plan, look forward and if there's a way that operationally you can find that money internally rather than a loan. I do that a lot with business owners as well too. Because there is that expense, that interest expense for debt financing.
So now what about if someone was looking for, say, like financing and say startup inventory, equipment financing and startup inventory kind of thing? And it would be more upwards of say like between 100 and like 200,000.
For a startup,
Yeah.
totally pre-revenue, that's going to be hard for a lot of lenders. Um, if you have something like you've been in operation for that year and a half, even 6 months, it is easier for a lender to say, okay, you've been doing it for this long and it's proved successful for this long. And so you have $100,000 that you want to purchase inventory and, instead of selling it in a farmer's market or, like a pop-up market somewhere, you're moving into a store. And so you have that lease identified and you've talked to the property owner and you know what that build out needs are. That is easier for an underwriter to say, okay, there's not enough of a track record to make this an established business, but there is a track record of sales. And so if the reasoning is logical and it's like, okay, this is a good space for this business, this is why it's a good space for this business, and here's all the inventory needs, here's where you purchase the inventory, and you have all that detail thoroughly outlined in the business plan, and you have collateral. So for a loan that size you're going to need collateral. And I know from our lending team, they do not like to take inventory as collateral. So it'll be that equipment, vehicles, or real estate. And for a loan, 100,000, 200,000, they're really going to look for real estate as collateral. It also depends on the lender too. I have had a startup business ask for a large amount, that had, between her and her spouse, they had a good amount of a household income, um, and resources tied up in retirement plans. Um, but our lending team, because it didn't meet the criteria, and as a nonprofit, we have a board that we have to answer to. Our lending team wouldn't do the loan, but I was able to connect her to a bank that, looked at the household income, and um, they were able to pull things for collateral that our lending team just couldn't. And so she was able to get, I think they were looking for 200,000. And they didn't own a home, they rented, but they had a good amount of household income, and investments that the other bank, the other lending institution, was able to leverage as collateral, so, or willing to take as collateral. So it worked out, even though it wasn't from us. It also.
Awesome. Thank you very much, Gwen, for leading today's class. And thanks everyone for joining us. We'll see you next time.
Bye. Take care.